Okay, hi everyone. I'm Chad Hitzman from ETF Securities. Thank you for joining me tonight. I'm going to keep it casual. I realize it's 5 o'clock. I know you've tuned in because you're very interested for us to hear us speak about gold. That is our #1 largest fund at ETF Securities. And given recent events, there is certainly much to say on gold. So right now, I want to wait just a little bit. I realize there's still some attendees filtering through. While I wait for that, I want to raise a quick question to gauge whether or not you're currently using gold. So I'm going to pop that question on the screen for you. And if you can answer it for me, that's going to help very much. So I'm going to put it on the screen now for you guys. And I can see that, as a matter of fact, it appears that a majority of you are using gold. And that makes it good for me to know, because I realize it's highly relevant, this presentation, to all of you now. Okay. I'm going to close that off. I think that's enough for me. Here we go. Okay. And let's get right into it. So first things first, I want to mention, if there's any point at which some of the topics that are covered, I realize there might be technical terms, concepts that you're unfamiliar with. If I'm not doing my job well enough, and I hope I will, in explaining those concepts in simplified form, call us up. Email us, check our resources on our website. Much information is to be found on the website. I'll try to do my best to make sure that all the information is clearly presented. So that's the housekeeping item I wanted to do first. Okay, let's get into the thick of it. I'm going to firstly provide something of a biographical background, as I always say and as I always do. Most of you might be familiar with our gold fund. And the reason for that is ETF Securities, since 2003, we've been in the market here in Australia, and we led into the market with our gold fund, our physically backed, exchange traded fund over gold. And our business, in other words, had been founded on the basis of gold. And we think that's a validation that gold does have a role in portfolios. So we've been here 17 years now running the fund. It's the largest gold fund, as a matter of fact, in Australia versus our peers. We're very glad to see that. Most in the market are very satisfied with the product structure, with the gold fund being physically backed, with direct ownership over the gold, with us also on our website providing information about the individual bars in our vault. So all of that speaks to the physical nature of the fund. But apart from gold, and I am sure this is interesting for you to know, of interest for you to know, we also do passive, index-based equity exchange traded funds. And we do that over thematic investment areas. So that is over trend areas we suspect have investment implications into the future. We also do equity income focused funds, so trying to achieve dividend yield and so forth. We do that over the ASX 300. We do it over the S&P 500. And we also have global infrastructure, et cetera, et cetera. So hopefully that gives a bit of a picture about who we are and the types of portfolios and funds that we're running on our side. Why are we here today? Well, I know we're all here today to hear about gold. And there is a lot of items here I'm going to run through, so bear with me as I do it. Forgive me if I'm speaking quickly. I realize also I have an accent. And that goes back to my first initial point. If at any time I'm being unclear, please do call through and you can speak to me, as a matter of fact, directly, and hopefully I can get to the heart of the matter better. First on the list, and there's something of an itemization of all the points we are going to cover today. And hopefully after this presentation, you're going to have more of a solid foundation in your understanding of the recent price performance of gold, the longer historical price performance of gold, gold's drivers. That is, what are the factors persistently associated in driving gold's price either up, down, and so forth. We'll also canvas, why invest in gold and why at ETF Securities we think there's a position for gold in portfolios. And also, item 4 there is investing in the physical gold, the precious metal, such as our exchange traded fund GOLD versus mining companies. I know that's a topic I regularly touch on in discussion with clients, and I'm sure you guys and girls are all eager to hear what we have to say on that. The 5th item is considerations that you should be aware of when managing your gold position into the future. Some things to think about. I'll also touch on point 6 on the different ways to invest in gold. There's not just exchange traded funds, there's other ways of doing it. And then lastly, I'll speak specifically a bit about our fund. And let me mention, just for clarity's sake, all of the information I'm going to provide you today is not specific in nature. It is general. And this is something of our compliance disclaimer that we necessarily have to state. And furthermore, keep in mind, all of the historical performance figures I show you are precisely that. They're historical. And there's no necessary correlation between past performance and future performance. So with those disclaimers out of the way, onward. Let's move onward. How has gold performed recently? So there's a bit of a scene setting for us to do now. I think from my perspective, our perspective at ETF Securities, gold in its story, if you will, it started back in 2018, I would say. The story of gold did not start specifically in 2020. It started in 2018, and there's several reasons for that. Advisors, I particularly, myself, I work with financial advisors, private banks, asset consultants, and so on. And what I saw in 2018 is a lot of those clients had reconsidered certain things in relation to their assets that they were currently holding. They increasingly became more interested in gold. And the reason that there was interest in the slide there in front of you speaks to the reason. I think it was 2018, 2019, when many began to think about whether or not there was an upcoming recession. And perhaps you guys have heard about the phrase late in the cycle. And late in the economic cycle, late in the financial cycle, there hadn't been a recession, for example, in the United States for over a decade. Here in Australia, there hasn't been until now a recession for some time. So it was on investors' minds whether or not that might occur, whether or not equity prices might come off. There was a lot of concern around equity valuations and so on. And as you can see, why people would be interested in gold if they had thought there was an impending recession coming is because usually gold performs well under the conditions of recession. That is to say, it usually performs well throughout the recession. And as recession begins to taper and dissipate and reduce, then you might see gold's price come a bit under pressure. And you'll also see there that last year, 2019, on our Bloomberg terminal, we saw that, analysts were expecting a 25% probability in 2019 of a recession for 2020. And we all know that the recession has come about. And the catalyst for it was, of course, the virus, the pandemic, because economies suddenly stopped. There were lockdown measures put in place for health and safety concerns. And you can see on that slide how dramatically equity markets, such as the ASX 200, NASDAQ 100, S&P 500, and there's a variety of other indices that you can look at from emerging markets, from a world equity index to Europe, they dramatically fell. And I should mention, this might be an interesting statistic for you, is the rapidity with which markets fell was the most rapid, historically speaking. So they were quite violently volatile to the downside from February 19th until March 23rd, when you began to see equity markets actually turn around and reverse. Corresponding to the negative impact that the sudden stops on economies, the shelter-in-place policies had on equity markets, and this might be interesting for all of you, and I'm sure you're aware of this to a degree, is that during this time, you also had an energy market, Saudi Arabia, trying to get other OPEC member countries to basically do controls around the price of oil. And the situation ended up that Saudi Arabia significantly decreased prices because in expectation of the decreased demand, given the sudden stops to the economies and so forth. The bottom line is that too did impact the drawdown. And I mentioned, though, as you can see, there's been a reverse course. And the reverse course occurred because you had concerted global efforts on the part of central banks and fiscal authorities to put a floor under and beneath asset markets. And you might have heard the phrase, "Don't fight the Fed." And essentially what that means is, if you believe Federal Reserve policy will be enough in their intervention and trying to push cash into the system, that is liquidity, and to calm equity volatility by doing that, if you believe that that's effective, then you should be of the mind that equity prices will be supported. And we all know here in Australia, that was done quite effectively. In the US, it was done effectively, and hence the reversal. And I know for a lot of investors, there might be something of an incongruity, a disparity between what's going on in the real economy in terms of heightened unemployment, but yet accelerated equity prices now. But the reason for that is because a lot of market participants believe that central banks' fiscal policy is going to be effective in cushioning the markets, as you can see there. Here is a bit of information on what gold's price has done over the past 12 months. And this segues into my first point that I mentioned in the scene setting section of the opening of the presentation, that the gold story, it commenced in 2018. And so even last year, 2019, it had some price performance. And you can see if you were invested in gold 12 months ago, in US dollar terms, it's now sitting at around 31%. That is up until May 12th. So from May 2019 until May 12th, 2020, that is its performance. Another interesting thing to mention here is that gold during the sell-off, the equity drawdown, actually itself came under price pressure. And that is to say, when you do have significant financial disorderliness. That's to say illiquidity, a lot of selling of your assets because you're trying to raise cash. Cash is the most sought after under crisis scenarios because it allows you to basically move to any asset class that you would like to. It allows you to meet liabilities on your balance sheet, et cetera, et cetera. So a lot of selling was occurring. That also affected gold. Now, the perception is that gold should hold its ground as equity markets fall because equities and gold aren't supposed to be strongly correlated. And the correlation just simply means that they're not supposed to move in the same direction at the same time. And, that's where the diversification comes from gold, is that it often does not historically move in the same direction as equity prices. So if equity prices fall, gold's price should rise. Now, when you do have heightened disorderliness, you also have the selling of good assets like gold to raise cash. Gold is very highly liquid. Other assets, not necessarily. So you did basically have cash raising by those who held gold before the drawdown. But the crucial point is this, is since gold in US dollar terms, and it fell about 12.5%, since it drew down, it has significantly rebounded. And we've seen in 2008 as well in the GFC at ETF Securities, we've seen gold have a similar behavioral trajectory at moments like this, is it will come under pressure and then it will rebound. Basically, once you have all the leveraged positions over gold cleared out, leverage is basically you're taking debt and you're buying gold on the basis of debt. But when markets begin to be pressured, you do not want to be in a situation where you're borrowing significantly in relation to holding certain assets. Once all of those types of holders of gold, those that are holding gold by way of debt, are cleared out, it usually sets up something of a launch pad, if you will, for further acceleration in gold's price. And that's what we did see. The other thing here, and I'm going to mention this later on in the presentation, is in Australian dollar terms, which GOLD is in Australian dollar terms, it's Australian gold. It actually didn't have a negative performance during that drawdown as did US dollar gold. This is the longer term snapshot of what gold has been doing for 15 years. So you can see at the bottom there, far right corner, for both US dollar gold at the top row, Australian dollar gold at the bottom row. And you can see that basically the average per year return has been roughly around over 9%, which is fairly sizable returns, I would say. And as you all know, in Australian dollar terms, gold is at historical highs in its price. How has gold been performing over the past 12 months versus other asset classes? This is a great slide. So I will immediately mention that often I hear gold is compared to a commodity. And if you look at that chart and you go all the way down and you see commodities, which is the second to the last asset in that table, you'll see it has performed net negatively over that period. But if you go all the way back up to the top and you look at gold, it's dramatically performed positively. So in other words, gold is not straightforwardly a commodity. And the reason is when you do have pressurized crisis scenarios in financial markets, gold serves as what's referred to as a safe haven. When you have those moments, you go to gold because it's a store of value in the sense that it tends to, under those scenarios, hold its value better than other assets. And you can see that. You can see that commodities did not hold their value more than gold. So there's not necessarily a one-to-one relationship in saying gold is a commodity. It's much more than a commodity from our perspective. What drives gold. This is actually one of my most favorite areas to talk about with clients. Before we get into this, I want to ask you, if I may, just quickly, and I highly sincerely appreciate you guys letting me know these things. I'm going to ask you a question. I'm going to throw it on the screen here. I simply want to know, and I just put it up on there. I hope you can see it. I simply want to know how well you understand gold. I want to gauge your understanding, and let me know, because if you truthfully let me know I know where I stand. So I will give that some time. I can see that most of you have a fairly solid understanding, which I'm very pleased to see. Okay, great. I can see that. Perfect. I'm going to close it off because I think that's sufficient. It tells me that a majority of you actually have a fair understanding of gold, which I'm pleased to see. This right here should serve as a framework for trying to understand what are referred to as the valuations, the valuation inputs, into the price of gold, which is to say, what factors are associated with gold's price increase, gold's price decreasing, and so on. And you could see there's a variety of things. And I have to admit, when first, my experience in coming to know gold, it could feel a little bit challenging. It could feel a little bit overwhelming. It seems to be something of an abstract asset. You could talk about statistical associations that drive its price in relation to other assets. So it seems a bit abstract, but it's not. I think it's fairly straightforward. But you also have very concrete, very non-abstract factors that do drive gold, such as you could see it there, China and India demand. And that simply relates to economic growth. So as economies grow, there's a lot of good positive forward economic momentum. It means that paychecks are doing well. It means that consumption of gold by way of jewelry tends to increase. But you also have things like interest rates. And interest rates are represented, and I'm going to get into the concept of real yields, but for now, think real yields effectively relate to interest rates. Real yields are actually after inflation interest rates. That's what real rates are. And you can see that in the purple circle to the very left. And right now, I can assure you that that factor has been driving the price of gold. It's an interesting one for you guys to delve a little bit deeper into, and it relates very intimately with what central banks are doing. So interest rates. Central banks have interest rate policies to try to get unemployment down. And they try to, they decrease interest rates to try to cushion and support asset markets. So the story there, though, and this is the crucial point. When interest rates are going down, it means that the opportunity cost, that is what you miss in holding gold, that's opportunity cost. It's basically I'm holding gold and I'm missing something by not holding another asset. So as interest rates go down, the opportunity cost of not holding something like a term deposit, where you earn interest, the opportunity cost is less, precisely because interest on cash is less. So usually there's a strong statistical association, which is to say, if you delved into the numbers, you can find an association, if you added up certain numbers, between gold's price going up and interest rates going down. And also tying into the real yield story, because it's after inflation interest rates, is inflation itself, which I'll talk on. You can also see that geopolitical factors tie into things, and you can think of the policy of Washington at the moment in the United States, trying to reconfigure the relationship it has with China in terms of, trying to get more reciprocity and accessibility to their market, rule of law, private property, and so forth. And also you have Washington trying to build up the industrial base once again. Things like that might produce a bit of tension, of course, and equity markets do respond to political developments. So gold tends to be a good, what's referred to as event hedge. So all of those there, again, in sum, are the factors to watch when considering your gold position. Now, I want to talk about one of the most important drivers, long-term drivers aside from real yields, of gold's price, and that's the demand for diversification. And diversification relates to this idea of correlation. And I put a few definitions up there, and I very much hope they're clear. And if they're not, give me a call. I'll be more than glad to walk through these concepts with you. But correlation is basically, the degree to which one asset price moves in the same direction to another asset price. So it's not correlated if your gold price moves up as real yields move down, or as equities in price move down. So they're uncorrelated. And usually when you're devising an investment portfolio, you're trying to get uncorrelated assets, because that is the very definition and essence of diversification. So if you ever hear diversification, that's basically what it means, is trying to get uncorrelated assets into your portfolio, so you're not putting, as they say, the proverb in investment, all your eggs in one basket. So if you put 100% of your investment deployable cash into equities, and equities fell 35%, which they approximately did in the recent drawdown, you're going to lose a substantial portion, 35%, full on the equities. But if you also had it in something like gold, well, gold is going to counterbalance that. And that's the idea. And so historically, investors support gold's price by continuing to buy gold, particularly at certain distressed moments, and also over the long term, because they want the diversification. And you can also see there that, the correlation, it's both in terms of intensity and direction. So I mentioned moving up and down, but the degree to which it moves up and down in relation to one another. And you can see that the correlation runs from +1 to 0, which means it's completely not correlated, to -1, which means it's perfectly negatively correlated, So if gold goes up, equities are going down, if it's the case. And you can see on the bottom there, the correlations are very low for gold in relation to Australian equities, global equities, and commodities. In the commodities one, I showed you that chart. So hopefully you can see that those statistics on the bottom are actually validated. The next driver of gold's price is what's referred to as volatility. And volatility, the word is simply that uncertainty in relation to what you expect future equity price movements will be. And the higher the volatility, it means that you're less and less able to have a solid expectation, future expectation, about equity prices into the future in relation to the S&P 500. So we use in investment land an index, basically a benchmark or a measure of volatility referred to as the VIX, and it's colloquially known as the fear index. And that will serve to give us an indication on the degree to which it's terribly hard or easy to expect future price movements. And when the VIX is above a measure of 30, usually it indicates that there's a fair degree of uncertainty in the market. And mind you, in March, the VIX actually reached a level of 80, and that's quite high. So on average, when volatility happens, it's positive for gold's price, because gold's a store of value, and you go to assets under those circumstances of uncertainty that are going to hold value well, more or less. Inflation. Now, I am almost positive that most of you, when you think about gold, you think about it in connection to inflation. And you're right to do that. So over the very, very long term, inflation, if it rises, gold has a good ability to preserve its value against inflation. And inflation is basically the price level price levels in an economy of goods, so consumer goods, services, and so forth, are rising economy-wide. And what that means in relation to hard currency, dollar currency, is that the purchasing power of your currency is diminished. That is, you need more and more dollars to buy goods. And that's not an entirely healthy thing for an economy to experience. So basically, inflation means that your dollar commands less and less goods. And gold, though, actually, when inflation happens, it tends to increase in price, thereby guarding itself against inflation. It commands more dollars under circumstances of inflation. And this segues into the real rate story. And I talked about this, I underscored this earlier on, and I'm going to, the slide deck that we're running through right now, I've put it up there for you guys to see in the handout section. So download it. So you have this forever on hand and you can always refer back to it. But real rates are after inflation interest rates. So it's inflation adjusted interest rates, because in real terms, you want to know, okay, if basically, let's say, for example, you have an interest rate of 1%, you invest $100, you have $1 earned over the course of the year, if it's 1% per annum. Okay, fine. But you also have to consider inflation. So if inflation is 0.5%, it means your real return, that dollar, is actually 50 cents, because it means that when you get that dollar back, it only commands fewer goods than it did before. So that's the idea there. So you can see how inflation, which we covered in the previous slide, actually comes to tie into the other driver of gold, which is real interest rates. And it also goes into this slide here. It goes into the idea of the opportunity cost. And as I mentioned, because gold does not give income, there's something of an opportunity cost in relation to those assets that do give income. So you're always asking yourself, okay, I'm holding gold, it's not producing income. It gives me growth. It certainly does give me growth under certain circumstances. And long-term, as I showed you over the course of 15 years, it gave growth in US dollar terms and Australian dollar terms over 9%. Okay. But nevertheless, I still like income. I like cash flow. And I know here in Australia, there's a lot of investors that do like dividend income. There's the franking credits, etc. So that is what you're looking at in relation to real yields and gold, is that while I'm holding gold, what is the opportunity cost? And when interest rates are low, there's a low opportunity cost. So a lot of investors begin to look at gold because it becomes attractive. And you invest in gold, and what you get is hopefully what you're expecting under certain circumstances is growth. So you may not be getting the income, but you're getting the growth now. So you go to gold for that reason. This here, I actually very much like this slide. And as I said, you guys, I'm leaving the presentation with you to explore. I hope you do. I know you're here to learn about gold, so there has to be a reason for that. You guys have interest, so I'm sure you can come back to this. I assure you, it's a fairly straightforward chart. But what it shows, the gold line there, appropriately so, is the gold price. And you can see the green is basically real interest rates, okay? And what you can see is that there are moments, and actually we did a little bit of an inversion on the y-axis there. But what it shows is that when real interest rates go down, you can see on the right-hand y-axis that gold's price is going up. It's not going down. Notice that that's just the way we arranged it. It's so you can actually easily see that. But so there's an inverse relationship between the two, and interest rates have been going down. I told you guys this, central banks have decreased interest rates because they want to help support the economy. Opportunity cost of holding gold goes down. Investors go to gold for its growth performance properties. It's a really interesting slide. This slide right here And I know most of you like to think about inflation in relation to central bank money printing. And I know you're all probably wondering when inflation is going to kick in. I'm sure most of you are in gold right now as something of an investment play in expectation of inflation occurring. There's been so many dollars pumped into the monetary systems of Australia, of the United States, and so forth. So we're all wondering whether inflation happens. Now, there's actually, and you can see it there, something of a fairly powerful relationship to when Federal Reserve in the United States as a central bank, when they put more money, pump more money into the system, they're expanding what's referred to as their balance sheet. So you see on the black line there, Federal Reserve balance sheet. As the balance sheet goes up, as the black line goes up, all it means is more money, liquidity that is, they're pumping into the system so that they're supporting asset markets, so that they're trying to give cash to firms that just have liquidity issues to avoid those firms from becoming insolvent, that is inoperable. And you can see when central banks do that, gold's price, the green line, actually goes up. So as they're printing more, it's going up. And I suspect the reason is precisely why you guys, to a degree, are in gold now, is because it's there as an inflation hedge. So you can see that. I very much like that slide there. It's the black line is the balance sheet as a percentage of GDP in the US, and it's rising. You can see that ratio's rising. The other thing for you guys to focus on is central banks. Now, we all know in 1971, I'm sure most of you who are gold watchers, avid gold watchers, I'm sure there are a few of you who do that, know that in 1971, the US dollar was delinked from gold. So in other words, the US dollar was no longer backed by gold. It becomes a fiat currency, that is a non-asset backed currency, okay? And under that time period, around that time period, most central banks started to sell gold. But since 2010, and you can see that chart is from 2013 to 2020, but actually if you go back further, 2010, central banks have been net buyers of gold, not net sellers. So for over the past decade, they've been buying gold. And the reason they do this is because they have a range of what are referred to as reserve assets. So not only do they have a variety of currencies, but they'll have things perhaps like bonds, that is fixed interest here in Australia. I know you guys call it fixed interest, but more and more they're putting gold into their reserve asset portfolio as well. Now, recently the pace of central bank buying has diminished a bit, especially in relation to developed markets. The question I'm hearing on my side, and I engage with commentators on gold all the time, is whether or not developing markets might further diversify their reserve assets, thereby offering further central bank support for the price of gold. Another interesting fact is that Russia recently announced that it's halting its gold purchases. So for some time, and you can see that in the first quarter of this year, Russia bought a fair amount of gold. But since then, they've announced it would have been either earlier this month or last month in April that they're going to cease buying gold for now. They're not selling it. And the other thing in relation to Russia to note, and I'm sure all of you might appreciate this, is that as equity markets began to fall February 19th through March 23rd, note that Russia didn't sell its gold for dollars, to raise liquidity, to meet liabilities, to conduct certain transactions and so forth. Actually, they didn't sell it. If it needed to, gold's highly liquid, but the point is it kept it, it didn't sell any of those gold assets. And you would think, well, hey, listen, energy prices are very pressured. Russia is an export of energy. Maybe it needs to raise capital by selling gold. It's in the past, it bought a lot of gold. They did not do that. So I thought that might be an interesting insight on this topic. The other thing to mention here, and I'm not going to go through all of the supply and demand story in relation to gold in terms of mining on the supply side. You know, that side of the story is fairly bland. I would say it's usually the case that you have steady supply. I know during the lockdowns, perhaps it came off a bit, but I don't see any pressure on the supply side. But exchange traded funds. So, you know, with exchange traded funds and offering access to physical gold, they've democratized accessibility to that asset, to this asset that is gold. And you are all here today precisely because it's easier to access gold than it was in the past. I mean, I'm sure you can still go and get bars and coins and so on and so forth, but ETFs make it highly easy to access gold. And you can see that gold ETF holdings have accelerated quite dramatically at historical highs, in fact. Now, this is the one I'm sure you guys have all been waiting for. Miners versus the physical precious metal of gold. And the key things here to mention is simply that when you buy a mining company, of course, you're buying a company. You're buying exactly precisely that. So you're buying a balance sheet. Gold does not have a balance sheet. And actually, you know, because gold doesn't have a balance sheet, it means it has different performance properties than companies. And that's where that diversifying effect comes into play. You know, it's driven by different things than something of a balance sheet that equities, that is stocks and companies have. So you have to consider when you're buying a gold miner, you know, the company that you're buying, its management, its cost structure, its reserve levels, you know, and how well it is at successfully mining gold. And interestingly enough, in that performance table there, gold versus gold miners, over the past 15 years, gold has actually outpaced mining companies on average. This is another slide worth mentioning to you guys, is that we at ETF Securities see gold fundamentally as a risk management tool. So we really watch moments where when equity markets fall, we ask ourselves, you know, did gold hold its value better than other risk assets? And risk assets are things like equities, that is stocks. And you can see there in dollar terms, okay? Because I mentioned earlier that at the outset of the drawdown, US dollar gold did come off, but in Australian dollar terms, it didn't, in fact. And you can see miners, they came off a lot because they are equities. So what I'm trying to say in this slide is that gold for us is a risk management tool for moments like February and March to try to preserve your capital value. And that's where we come to right here. Now, I want to talk about how you access gold. And I know this is another interesting question I regularly have. I already suggested you can do it by way of exchange traded funds. You can do it by way of bars, and you can do it by way of coins. You can do it by way of synthetic exposures. Now, a synthetic exposure effectively is something like Perth Mint. You have a variety of choices. There are differences between each of those. Now, I like to say that if you buy bars and coins, there's a bit of transactional friction. And what that means is, you know, you cannot readily buy and readily dispose of your gold holding as you could with, say, an exchange traded fund or Perth Mint Gold, because you can just hop online and immediately trade it. If you hold a bar, if you hold a coin, you have to go find a gold dealer. And furthermore, you have to have the purity of your gold re-verified. Once you take it out, for example, under your mattress and you bring it into a gold dealer, you have to have it verified once again, its purity levels and so forth. Whereas with an ETF or Perth Mint, you already have, you know, 99.9% pure bullion, because the fund requires the gold that it's buying. ETF Securities, we require our gold that we're buying to be of that purity level, and you don't have to worry about it. So there's a few differences there. The other thing to mention, though, is the way that we structured our product is that there's immediate ownership that you have over the gold. And this is the key thing. Even if it's the case that a fund says it's physically backed, it does not always mean that you have immediate ownership. You have to delve a little bit into it, but let me just say, for our fund, you have immediate ownership of the underlying bullion. And that's our fund right there for you guys to view. We have the management cost there, which is 0.4% per year. The gold is vaulted with our custodian, JP Morgan in London. And I've also had this question in relation to the custodian. If our custodian goes broke, that is, if the largest bank in the world, JP Morgan, goes broke, our assets are segregated from their balance sheet. Our assets aren't theirs. So nothing affects our assets. And our gold product, our ETF, can be redeemed for the physical metal, although there's associated cost. It's rare that this occurs because you have to do other things to be able to do that, but the option is there. And this goes back to gold as a risk management tool. I first wanted to talk about how you access gold. Then I wanted to talk about looking at its portfolio effect. So if you throw gold into your portfolio with your equities that you have, your fixed interest that you have, and anything else that you have, your property that you have, you know, how well does it blend? How well does it diversify? You know, how much is it uncorrelated to those other assets so that you have something of a balance in the performance? You know, you're riding out, you know, when your equities aren't doing good, your gold might be doing good. So they all try to smooth out the returns. Now, the columns there where it says the return, those are the average returns. And the standard deviation, just ignore that concept right now. I mean, what it basically means is volatility, you know, how much the portfolio performance might move, and that in terms of percentage terms. Okay, all those first two columns, the return and the standard deviation, are in terms of percentage. The max drawdown is how much the portfolio falls. And so we just went, say, let's put gold at 2% in one portfolio, at 5% in another portfolio, at 10% in the other portfolio, and let's watch these statistics. Let's see if it improves the return. Let's see if it reduces the volatility, and let's see if it basically reduces the degree to which the portfolio falls negatively when you have that drawdown. That's what max drawdown means. And you can see basically on all measures, gold tends to improve those items. And therefore, we see it as a risk management tool. And that fundamentally means you're taking less risk per unit of return. And that's referred to as risk-adjusted returns, which you have to consider. I mean, if you go after returns and you might get it, but yet at the same extent, if someone said, hey, listen, you might have profited heavily, you know, you got 50% returns, but did you know, you're getting 50% returns, it's kind of 1 out of 2,000 probability and things like that. So then that might make you think, oh, well, that was quite risky. I did profit, but after I consider risk in relation to the return, maybe it's not such a good return in terms of the efficiency of the return, the risk-adjusted return. That's how we perceive returns in investment management. We always think about the risk-adjusted returns. How about considering things like managing your gold position going forward? What I will say is this, is that for listeners that have experienced a lot of price action on your gold, some good price performance, you might want to think about rebalancing, taking some of that profit back so that you feel a tangible benefit of that gold. And that actually appropriately allows you to manage the position and not overextend yourself, not bet so much on gold, and you get a tangible benefit and you can profit take, which does help. But you have to do that, cost efficiently. I realize that trading all the time is a cost. So you have to think about all those things. You have to think about, okay, have I profited significantly? Is it cost efficient to do the trading? That is the profit taking. That's what rebalancing effectively means. I should have said, excuse me, I apologize. Risk rebalancing is basically bringing the proportion of your gold exposure back to the initial proportion. So if 5% of your portfolio was initially in gold, gold's price increases, now it's 10% of your portfolio, the profit taking and rebalancing means that you bring it back to the 5% and you're controlling things. That's what you should be doing. And that all ties into also with asset allocation. And I know I said you should be doing, I'm not providing advice, but that is academically speaking, research-wise speaking, asset allocation is, is very much supported in research literature. The other thing is monitoring the strength of those tactical drivers of gold. And the chart that I showed you at the very beginning, it listed all of those drivers. And you can break them up in terms of strategic and tactical. Tactical short-term drivers, they tend not to be persistent over longer terms, short to medium, that is term. Longer term drivers, they tend to be persistent over, longer spans of time. But you just want to look at those variety of factors. Say, okay, well, are they dissipating? Are they strengthening? What does it mean for gold's price going forward? Also, though, if you do profit take and you have some cash, at the end of the day, you have to think about, okay, well, what do I do with that cash? And perhaps you have an appetite for equities. If you're willing to obviously commit to equities, holding them for a period of time, and you're able to undertake that risk. We at ETF Securities, as earlier on I mentioned, we don't just do gold. We also have exchange traded funds, that is ETFs, over a variety of stocks. That is equities. And we do them over ASX 300 companies. The ASX 300 companies aren't there. They're not listed there. But if you go to our website, you can see it. That slide right there where I'm highlighting what's referred to as our thematic range, our, I guess, more exciting range. So we cover companies, for example, that are in the FANG stock. So Apple, Netflix, Amazon, and so forth. And those companies have been accelerating the S&P 500. Yeah, those companies tend to have really good balance sheets. They're dominant within their respective markets. Their market shares are very well guarded and so forth. We also do a portfolio, an ETF, an exchange traded fund over biotechnology companies, which is highly relevant today. So that portfolio, the ETF over biotechnology, we have a few companies in there that are actually pursuing a vaccine expectedly for COVID-19. So they're in the race for that. We also cover companies in robotics, automation, and artificial intelligence. And I will tell you now that one discussion that I am hearing on my side is how can firms make their supply chains more resilient, especially after given all that has occurred in the stopping of the economy and so forth, because we're all sheltered at home. And I can tell you that robotics and automation are going to feature, especially in the long term, in that process of trying to make sure that your supply chains are more resilient in terms of automating, using artificial intelligence, and so forth. We have emerging markets in India, and we also do other things like silver. I'm sure most of you, are interested in silver as well. We also do a mixed metals basket. That's the mixed metals basket right there. And it shows you the breakdown of, which metal we invest in and the degree to which we invest in it. That's it, guys. I'm not going to hold you much longer on your Wednesday night. I'm very happy you guys all tuned in to hear me speak. I hope in some way I helped. If I didn't, give me a call, and have a wonderful night. So thanks again, guys. Bye.